You are missing out on massive swing trading gains just because you don't know how to trade options. My name is Phil, I've been swing trading for over 6 years, and yes, in the beginning I also had no idea how options work, but after learning about them, implementing them, I'm now at the point where options allow me to make a full-time income on just one single swing trade. Over the course of this video as well as the next video, I will break down exactly how options work and how you can go ahead and swing trade options in order to start making a lot more money on your swing trades. So today we have quite some educational content, but before we actually talk about any swing trading strategy regarding options, it's very important that you first of all understand the basic principles regarding options. As you know, Swing Trading Simplified, so therefore we're just going to focus on call options, since literally almost all of my personal swing trades are with calls. Now, question number one, what is the mysterious word option? What does an option mean? There are four key aspects of an option. An option is the right, but not the obligation, to purchase the underlying asset at or on a specific date at a specific price. And there we have it. This is what's a call option. The right, but not the obligation, to purchase the underlying asset on or before a specific date at a specific price. The date here is also what you call the expiration date, when the option expires. And the price where you can buy the underlying asset is called the strike price. That's so far all you have to know. The right but not the obligation to purchase the underlying asset on or before a specific date at a specific price. We're not overcomplicating things here, because that's not what I'm using for my personal swing trades. What's very important for you to understand is that one call option always covers 100 of the underlying asset. So for example, we're talking about a stock call option. If you purchase one call option of an underlying stock, you're actually moving the value of 100 shares of the underlying stock. One call option always covers 100 of the underlying asset. So let's already take a look at an example here. And you are all familiar with the stock. Last trading at 183, we are actually talking about NVIDIA. And here you can see a classic options chain of NVIDIA. At first, I know it might seem a little bit confusing, but let's break it down step by step. Keep in mind, an option is the right, but not the obligation, to purchase the underlying asset, which obviously in this case is NVIDIA. And keep in mind, if we're talking about options, one option would then actually cover 100 shares of NVIDIA to purchase the underlying asset on or before a specific date, which is what we call the expiration date. And you can find the expiration date here. In this case, you can see expiration date is March 19th. So on or before March 19th, you can decide whether you want to exercise the option, whether you want to actually have the right to purchase the underlying asset, in this case NVIDIA, on the 19th of March or before the 19th of March. And now all that's left is the strike price, which you can find in the middle here. And there you have different strike prices. And that's already all you have to know, how to read an options chain and what this actually means. Now it means, if we just put it into simple language, if you buy one NVIDIA call option expiring March 19th, for example, strike price $180, that on March 19th or at any date before March 19th, you can purchase, if you buy one call option, 100 shares, if you buy two call options, 200 shares, etc. But if we just say one call option, you can purchase 100 shares of Nvidia at $180. And in order for you to get the right, because obviously nothing is free out there, you have to pay a premium, which in this case are $39. Because here it says last, this is what you have to pay in order to get the right, but not the obligation, to purchase 100 shares of Nvidia on March 19th or at any date before March 19th. You pay $39 to someone else. And keep in mind, every option covers 100 shares, so you have to multiply it with 100, which is roughly 3,900. What you have to pay in order to get the right. If you then go ahead and exercise the option, obviously you can purchase Nvidia at 180, which will then cost you exactly 18,000 bucks, since one option always covers 100 shares of the underlying asset. We're not taking a look here at the right side, since there you can see we're talking about put options, nothing which I'm personally interested in 95% of the time. We're just talking about call options, meaning the right but not the obligation to purchase the underlying asset on or before a specific date at a specific price. So far, very, very simple. You can also go ahead and pick a different strike price, 165. If you purchase this option, obviously you have to pay more, $47. And this means that if on March 19th or at any day before March 19th, could be tomorrow, you decide to exercise the option, you can purchase 100 shares of Nvidia at 165. But in order for you to get the right, you pay $47, obviously times 100, which is 4,750. This is how an option works. I know if we break it down to the bare minimum, it's not difficult. The right but not the obligation to purchase the underlying asset on or before a specific date at a specific price. One option always covers 100 shares of the underlying asset. And then you can just type in Nvidia options chain and you see it. Now, why are options not free money? Because every once in a while people think options are free money. No. Because you can see Nvidia is currently trading at 183. And if I want to buy Nvidia at 180, I can sell it at 183. This would immediately give me a $3 profit. You're absolutely right. But keep in mind that in order to acquire the right to buy Nvidia at 180 here, we have to pay $39, which means that if we make a profit of 3, but we have to pay an additional 39, we would actually end up down 36. So therefore, if we buy the option today and tomorrow Nvidia is still at 183 and we exercise the option, we would immediately lose $36, obviously times 100, which is $3,600, which you would immediately lose. Simply doesn't make any sense. So we still have to be right with our underlying analysis before we can actually go ahead and purchase options. You cannot purchase options out of thin air and you're not guaranteed to make money. But if you have a proven strategy, options are simply a vehicle of making more money. Why? Let's actually take a look at a numbers example. Here you can see a very decent graph, and we're now taking a look at 4 scenarios. 4 scenarios of Nvidia, so therefore we have to keep the prices in mind. Let's say we are talking about this 180 strike price, which we have to pay $39 for, and currently Nvidia is trading at 183. So that's something which we have to keep in mind. Strike was at 180. The premium, which is what we have to pay, just a fancy word, is at $39. And currently Nvidia is trading at 183. Those are all the numbers which you need. You can see it's not difficult if you understand the 4 main principles of an option. Now, scenario number 1. At any point before March 19th or on March 19th, Nvidia trades below 183, so below what it's worth today. If it trades below 183, or let's make it even more extreme, Nvidia actually trades below 180. So below our strike price, where we can go ahead and buy the underlying stock. It wouldn't make any sense to exercise the call option. Keep in mind, a call option is the right, but not the obligation. So you can just go ahead and not exercise the call option at all. Yes, you lost your premium, but why would you go ahead and purchase Nvidia at 180 at the strike price when it's currently trading below 180 and you can just go ahead, go to the regular market and buy it, for example, at 175? It wouldn't make any sense for you to do this. Therefore, the option, what we say, expires worthless, which means that yes, you lost your premium, which you put in, your 3,900, because obviously this has to be, once again, times 100. You lost 3,900 and you don't own any Nvidia shares. So it wouldn't make any sense for you to purchase it at 180 exactly when you can purchase it anywhere below 180 when you just go to the regular market. Scenario number 1. Scenario number 2. Let's imagine Nvidia trades exactly at 183. So it simply didn't change at all until March 19th, 2027. What do? Very simple. It also doesn't make any sense for you to actually exercise the option. You could do it, but you still lost money. You can buy Nvidia at 180 and sell it at 183, which means you have a $3 profit. $3 profit. But keep in mind, you actually had to pay $39 times 100. So you do minus $39. And this means that you're still down $36. So there you can see, literally doesn't make any difference at all. In this case, you're still losing money. $36 times 100 is $3,600. So you would still be left with an overall loss of $3,600. 36 times 100. This brings us to the question, which price does Nvidia actually have to reach in order for us to make money? And in order for us to make money, the break-even price of an option is always the strike price plus the premium we pay. So let's imagine Nvidia on or at any day before March 19th is trading at 219. Nvidia is trading at 219. Why exactly 219? Since 180 here plus 39 is 219. Let's imagine Nvidia is trading at 219. This means that you can purchase Nvidia shares at $180, 100 shares for example, for 18 grand. Immediately sell them for 21,900, which obviously gives you a profit of 3,900. But keep in mind, in order to purchase the option, you had to pay 3,900. So overall, you broke even. If you want to calculate the break-even price of an option, you just go strike price plus premium. That's your break-even price. If Nvidia on March 19th or at any date before March 19th would then trade below 219 or at 19, you're either break even or lose money. If it's above 219, you make money. So let's say, for example, Nvidia trades at 300, so way above our break-even price. Now you can purchase Nvidia for $180 plus the premium which you had to pay, which is 39, meaning that you have to pay a total of 219. You can immediately sell it for 300, meaning that you make a profit of $81. You make a profit of $81. And there you can already see the beauty of options. You make a profit of $81 with an initial investment of 39. Obviously, we still have to multiply both with 100, so you make a profit of $8,100 by putting in $3,900. $3,900 is what you put in, And 8,100 is what you get out, meaning that you have more than plus 100% on your options play. You more than doubled your money on the options play. Whereas Nvidia went from 180 to 300, which is roughly plus 60%. So there you can see we already have the leverage component of options. A major advantage of why we actually use options is because they give us leverage. If a stock substantially moves, or any position moves substantially in our favor, options can always give us an opportunity to over-proportionally capitalize. And therefore, it's very important that you understand how they work. Options over-proportionally capitalize during moves towards the upside, while simultaneously minimizing risk. Because all you can lose with options is the premium you put in. Remember, if Nvidia is anywhere below 219 or at 219, we simply don't have to exercise our option. We simply don't have to exercise our option, meaning that we just lose the $39 times 100, the premium which we had to pay. So all you can lose on any given options position is the premium. It perfectly allows us to manage risk. And every once in a while, you then have an over proportional win. Meaning that if you're right on a massive winner, you're not just having a leverage of 2x, 3x, 4x, you can have a leverage of 5x, 10x, 20x if you catch a significant winner. Those are the swing trades which you want to catch every once in a while, and they will massively boost your performance. You won't be able to catch them with the regular stock, but you will be able to catch them with options. However, you still have to understand with options, and that's something which I will then go ahead and repeat in the second video of the options strategy, where we will then take a look at charts and how you can go ahead and implement options. It's very important that you understand all you put in. So your entire premium is at risk. And therefore, with an options play, you can lose, and it's inevitable that you will lose 100% of what you put in. Yes, it's only the premium. In this case, 3,900 for one option. 7,800, for example, for two options. And if you decide to purchase two options for 7,800, you can lose the entire 7,800 which you put in if Nvidia actually trades below the strike price plus your premium, because then you lose money. If it trades below the strike price, you lose the entire premium. If it trades above the strike price but below your break-even price, then you lose part of the premium, but there is always the risk that you lose everything which you put in. That's something which you have to understand when you're looking into options, because otherwise they will screw you. But here you have a basic breakdown of how options actually work. You can see nothing magical. An option gives you the right but not the obligation to purchase the underlying asset on or before a specific date at a specific price. The only two metrics which are important is the strike price and the expiration date. And now we have to put everything together into an options strategy. Something which you see me do live every single day for free in the Swing Trading Academy. You can just go ahead and check it out first thing in the description, because there I'm just applying the same option strategy over and over and over again. And the next week I will go ahead, share with you my screen. We are going to take a look at some charts and we're going to go over the options strategy. If you enjoyed this kind of more educational breakdown, less fancy, but therefore really giving some massive value to you guys, just make sure you smash the like button below this video. I will see you inside the Free Swing Trading Academy. First link in the description. Don't get caught up in any of the short-term volatility. Keep your long-term vision.